Good morning once again, options traders. Well, this comes to us from an anonymous tip from our trading forum. I feel like I'm on a Crime Stoppers hotline here, but the guy didn't leave a name, but just said, could you talk about the zebra strategy and in particular, compare it to a long, deep in the money call, such as the stock replacement call? And while I was laying out the presentation, I found out it was going to get a little long. So I'm going to break it up into two parts. Here, we're just going to talk about the zebra strategy. And then in the next video, I will do a comparison between the zebra strategy and a long, deep in the money call. So for right now, let's get started with the zebra strategy. What's this thing all about? Well, before we get started, as always, please be sure to click like and subscribe. It is greatly appreciated and helps to promote the channel. So the zebra strategy, what is this? Well, first of all, let me say, when you see stuff like this, some kind of a new name for a strategy that nobody's ever heard of, it's simply a marketing gimmick. And by that, I mean they're trying to make it sound like it's something that it's not. They're trying to give it a fancy name for something that's just simply the combination of two strategies. If you want to go up and say, let's trade a straddle and a vertical spread and call it a giraffe, by all means do it. But you're just going to make things more complicated by trying to make them into something that they're not. So the reason that I think this is more of a gimmick, as you'll find out, it really seems like they're just trying to offset theta. So here's what the zebra strategy is all about. They tell you to sell an at-the-money call and then buy two in-the-money calls, each with half the extrinsic value of the short. So however much extrinsic value was in this short call, the at-the-money, you're going to look deep enough into the chain, going to lower strikes, until the extrinsic value is half this amount. So why are they doing this? Well, if you buy two of those, 2 times a half is 1. They're just trying to cover all of the extrinsic value on the two calls that you're buying. So for example, let's say that the stock is 100 and you sell the $100 call. So this is an at-the-money call, so it's all extrinsic value. And let's just say it's $5. Now the strategy says to buy two in-the-money calls, each with half the extrinsic value of this short. So maybe we look down into the chain and find that the 95 calls are trading for $7.50 each. So notice what's going on here. The $95 calls are $5 in the money. Stock's at 100, so they've got to be worth at least 5. That's the intrinsic value, but they're trading for $7.50. So there's $2.50 of extrinsic value, but you're buying it twice. So you're spending $5 of extrinsic value and collecting $5 of extrinsic value. And again, the idea is that you are offsetting this theta. In this example, your net debit would be $10, and that's because you're spending $7.50 times 2, or $15, and then you're getting a $5 credit. So 15 minus 5 is 10. That's your net cash outlay for this zebra, for this example. So again, why is this a gimmick? Well, I can't help but think that wherever this strategy came about from, that the trader was just trying to offset theta. They're trying to eliminate it. So again, you're collecting $5, you're spending $5. Hey, we have no theta. But as I've talked about in many videos, everybody likes to eliminate theta or hedge theta because they think it's the biggest risk in options trading. But remember, theta is not a risk. It's a characteristic of an option. And the reason it's not a risk is that risk is always defined as uncertainty, things that we don't know. But time moves in one direction at the same speed, it's 100% known. In fact, it's one of the few things in options trading that we do know with 100% certainty. So as you'll find out, the zebra strategy is simply a -1/2 ratio spread. These have been around forever. Since the beginning of options trading, ratio spreads have been around. So again, it's really unfair to repackage it and just give it a different name. Now there's a little twist here to the way that they've done this one, but it is still a -1/2 ratio spread. What this means is that you have sold one option, that's the -1, and you have purchased two. That's the plus 2 right here. So most of the time when people talk about a ratio spread, or in this case, a -1/2, they are thinking of a backspread, which means that the strategy would have this type of a risk graph at expiration. This would be selling the 95 call and buying 2 of the $100 calls. So you can see most of the time they try to position this strategy to where this left wing out here is slightly above zero, so that even if the stock collapses, you've at least got something to show for it. But you can see if you sold one call, you're just following that part of the risk graph. That's a short call. If you were to buy one of the hundreds over here, you would flatten out. It would just be a credit spread. But by buying the second call, you've now lifted this leg up into positive deltas, and so that would be a back spread. So a lot of times when traders hear the zebra strategy and they say, oh, it's a -1/2, they envision this type of a spread, and it's not. Because the twist is that you are actually buying the lower strike call. And as I've talked about in previous videos, lower strike calls are always worth more money. That's what we call the controlling strike. So if you're buying 2 of these and selling 1 of these, it's still a 2 by -1, but it's not a back spread. And so here's what you're doing. Let's say that you sell one $100 call and then you buy 2 $95 calls. Well, let's split up these 2 $95 calls so that we just have 2 singles, and then let's pair one of them up with this short call. And what is that over here? This is simply a vertical spread. So all you're doing is you're buying this 95 call for $7.50, and you're buying the vertical spread for $2.50. So on a net basis, you're buying both strategies for $10. So there's nothing special about that. People buy calls all the time. People buy vertical spreads all the time. But when you put them together and package them up with a fancy name, everybody says, oh, this is awesome, because you're eliminating theta. And as you're going to see, you're not really doing that at all. To a certain extent, under certain conditions, you will, but there's still a lot of theta going on here. So let's take a look at these 2 trades by themselves. There's our long 95 call in black. Get our bend at 95. We're paying $7.50. That's our max loss. And here in red is the 95-100 vertical spread for $2.50. So we can see that's the maximum loss right here. So if you combine both of these risk graphs, so in other words, these are the only 2 positions in your account, what's it going to look like on a net basis? Well, it's going to look like this. And so if the stock closes below 95, you've got no deltas, everything goes out worthless, you're out $10. But if the stock is above 95 and below 100, you're on this sharper angle right here that has 200 deltas. Why? Because you're actually long 2 calls. You're long the 1 call, and then you're long the call from the vertical spread. Or you could go back to the original design where it said buy 2 calls and sell 1. So you've got 200 deltas through here. But if the stock goes above 100, you've only got 100 deltas. Why? Because the vertical spread taps out. After 100, the vertical spread has no more deltas to this side. You just have the 1 long call. So a lot of times when traders do a strategy like this, the stock is going to be down here somewhere in the red. And they're doing it to try to bump up these deltas in here, get some acceleration or some leverage, and then maybe kind of fade out if the stock continues higher. But the risk of this strategy is that you're doing it with the stock right here at 100. So you're never benefiting from these 200 deltas at all. They are simply a risk. You are going to be playing, if everything goes as expected, in other words, the stock is going up, you're going to be on this 100 delta curve. But if it goes against you, now you're on a steeper slope. And that's really what's offsetting the theta. You're simply collecting a credit, taking bigger risk, and mentally saying, let's apply that credit to the theta of the call that I'm buying. All right, well, if that makes you happy, you could do that for any strategy. Buy a call and sell 10 naked puts. Take that big credit and say, I've more than offset my theta. In fact, I've got positive theta. Sell a whole bunch of spreads. Say you've got all kinds of positive theta. There's nothing special about it. It's just 2 different strategies overlaid on top of each other. So let's take a look at just the long call. Remember, we're going to separate them out. We're long the 95 call. We're also long the 95 100 vertical spread. So once again, we have our bend right here at 95. The black line is our expiration graph, but the red line is the current curve. And notice that we will always have negative theta, always. And that's because this red curve will slowly work its way towards the black line at expiration. It's always going to be sinking. So part of your strategy will have negative theta always. Now let's look at the long 95 100 vertical. So it's easy to just look at that short $100 call that you collected $5 for and say, oh, I've offset theta. But remember, when we pair it up with one of the longs, we get this vertical spread. And over time, the current curve here in red does what? It moves towards the black. And then sometime later, we go to this blue line. Maybe a week later, we go to the green line. And so in this region of the graph, let's say everything above the expiration break even, yes, you do have positive theta, but not across the entire vertical spread. Down here, you can see that the red line moved down towards the blue and then towards the green. It's moving down towards the black. You've got negative theta in this region. So if we compare our long call with the long vertical, you can see we have negative theta throughout the entire range here. We have negative theta through basically half of the range here. We have positive theta only in a small portion of the vertical spread. But remember, you can see from the lines moving towards the black here, it's not positive theta instantly. You absolutely need to wait for time to march by before you're going to start offsetting the time decay from your long call. So the thing to understand when you break strategies apart like this is it's very clear to see that theta neutral, which is the idea of the zebra, doesn't mean zero theta. That's a fallacy. Everybody thinks, oh, I have no theta. That is absolutely not true. So for example, let's go back and combine both of these again. Here is the zebra. This is the expiration graph. Now with time remaining, let's say with 30 days, this would be our current curve. Now remember, you're starting the strategy with the stock right here at 100. So you don't have a lot of negative theta. You can see that that blue line will work towards the black unless that stock really gets way up into here. But if the stock falls down into here, you will absolutely be experiencing negative theta. So let's say some time goes by, you're going to move from the blue line to the red, and then the red to the green, and then down here to the purple, and down here to the blue, and then to the orange. And you can see what's happening. You are just constantly sinking lower as time goes on. So remember, you would have only spent $750 on a long call by itself. But because you purchased the vertical spread for $250, your maximum loss is now 10 if it goes against you. You've doubled down on your deltas. So you're starting up here hoping that the stock goes up. But if it goes against you, you will quickly have very large negative theta and you will have much larger losses. And again, that's why I say it's just a gimmick. It's just another strategy, selling this call and then applying that credit to the extrinsic value of the two long calls. So notice here is our zero line, meaning zero profits and losses. And you can see that if the stock is just slightly above 100, actually quite a bit, even almost up to 105, these current curves are still above the black line. You still have some negative theta. And that's because the negative theta on the long call is overpowering the positive theta on that vertical spread. However, if you get really close to expiration, you can see that these lines actually dip below the black and you would have positive theta. But look at how small that little area is. It's nothing to speak of. That wouldn't be a reason for doing this strategy. But you can see that these bands, these colored bands here for the current curves, are fairly close to the black line. And that's telling you that for the most part, your theta has been offset in this region. Just not totally, and definitely not if the stock falls. So if we look at this as just the long call, in other words, if you would purchase just the long call versus the zebra, right, here's your long call that you could have purchased for $750. But by also buying the vertical spread, you've now increase the maximum loss from 750 to 10, you've got an additional $2.50 loss on this side. And part of the benefit for that is that you have shifted this break-even point lower. So you can see that the black line right here at expiration breaks even at 102.50. That's the 95 strike plus the 750 purchase price. But if you look at the red line, the zebra, it breaks even right at 100, which remember we're assuming is where the current stock price is. And so now you can clearly see that on the left-hand side, you've introduced $2.50 of additional risk in exchange for over on the right-hand side, the difference between this red and black line is $2.50. So yes, you have the ability to make $2.50 more if the stock goes up as planned, but you also have the ability to lose $2.50 more if it goes against you. So why is this suddenly some kind of a magical strategy that offsets theta? It's just two different strategies on at the same time with a fancy name. So to see this a little bit more in action, let's jump over to an E-Trade platform and take a look at the spectral analysis. So now we're into the E-Trade platform, and I'm going to use NVIDIA. It's always hard to find a stock that closes exactly at the strike, but this is pretty close. So 133.57. I'm going to choose Feb 25. We've got 36 days to expiration. And so remember what the formula is. You're going to sell an at-the-money call. So if we look down here, I'm going to choose the one with the greatest extrinsic value. Remember, by definition, that's kind of our at-the-money option. So we've got 669 there, 661, 620. Let's take the 134. So we're going to short that, and we will have $6 and let's call it 70 cents of extrinsic value. And now the other part of the formula said, go deep enough in the money to where you're paying half this amount in extrinsic value. So let's call it about 335. So let's come down here, and here's 321, here's 349. So let's take the 125 for the long position for the long two calls, and we will sell the 134. So here we go. Let's click on the bid, and then we're going to do a custom spread. We're going to buy, remember, 2, but we're going to buy in the money. So let's buy the 125 strike, purchase that 2 times, and so the amount of extrinsic value that we collected from the short call is exactly twice, within a few pennies, of the extrinsic value that we're going to be spending on each of these. So we should basically offset our theta. That's the idea behind it. We're going to pay about $19.28. Now, just to make it round numbers, let's go ahead and make it 20 so it'll be easy to follow. And now, if we click on snapshot analysis, we can see our risk graph, and there it is. That's what we saw. Let's zoom out. But now let's go to what's called the spectral analysis over here in TradeLab. So if I come down here, all right, so what we're looking at is we've got, this is the past, here's the future. We don't know what's going to happen here. If I grab this vertical line, I can drag it, and that's allowing me to look at different dates. We've got the dates along here, so I'm dragging to different dates. I can also click this line and move it up or down and look at different stock prices. So notice where we are right now, that if the stock price stays where we are, you see how there's a dividing line between the red and the green? You're going to be in losses all the way through this unless that stock price moves up. Now, it doesn't have to move up a lot, but it's got to move somewhat. And as we start moving through time, also watch down here. It's going to show us our Greeks in real time. So watch your theta. Let's start with that. We have about -6. So I'm going to grab this line and I'm going to move it slowly. Now watch that theta. You're -6. Starting to get a little less, working that way. Now we've finally gotten into positive theta, basically theta neutral. But look at this, this is on February 13th. Today is January 16th. So this is just about a month away before you're ever going to see that theta offset. Now let's say that the stock moves up as we expected. Let's take this back to today. Let's move the stock from 133.57. Let's go up to about 135. All right, so that's up. Let's take this again back to today. Now again, watch your theta. It's negative. We move through time. Not a big change. Still negative. Still negative. Getting less. Now we're into positive. Now that happens on February 11th. So a couple of days earlier, but not a whole lot. You are still going to have to hold this position a long time before you're going to see any type of positive theta or offsets in theta. Let's do it again. Let's take the stock up to 137. All right, so we're just starting to get into the green here. Now watch your theta. We start out at about -4 here. We start moving through time. Getting a little bit less, a little bit less, a little bit less. Now we're into positive theta. That's on February 6th. But you can also see, watch your deltas right here. We're going to be converging on 100 because our vertical spread is tapped out. So we've got some deltas from our vertical, but once it goes out, because it's in the money, you can see, and right there we go to 100 deltas. So that's if everything goes right. That's a pretty good clip up at 137. Let's say that things go wrong. Let's say it moves from 133 down to maybe 130, more or less. I can actually type it in manually. Let's do 130, type in a stock price of 130, and now move through time. Now watch your theta over here at almost -8. So you're just going to stay in negative theta land the whole time. So you're never going to get out of it, even though you theoretically offset your theta. It's just not going to happen. That's because your vertical spread is in the negative theta zone, and so is your long call. Now here, you can see that we did get into the 200 delta zone. So your losses, look at that, you're at -998. You're down 50%. Now let's do one last thing. I should have done it on the last trial. Let's put the stock price up into the green. Let's say at we'll go up to 130. Let's make it 138 even. 138. And let's start from today. Now, watch this box up here and watch your profits and losses. All right, so we're going to move through time. Keep moving, keep moving, keep moving, keep moving. So think about that. You had to hold that for nearly a full month. You're up less than 9%, made $176. But think about the risk that you took. And that's with the stock going to about 138 when it was at 133. So the main thing that I'm just trying to show is that there's nothing magical about this strategy. It is simply a long call and a long vertical spread. The big misperception that traders have is that they try to apply the credit from the short call to the extrinsic value of the two long calls, and they say, oh, it's offset. I've got 100 deltas if the stock moves up, and I've got no theta. What could be better? What they don't realize is how those two positions interact. So I'm not going to say that it's a bad strategy. I'm just going to say it's nothing more than two long calls and a short call that's at the money. And if you want to trade it for other reasons and other characteristics, but don't trade it just because you think you're offsetting theta, because you're taking a whole lot more risk to do that. And definitely don't trade it just because it's called a zebra. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a Candlesticks and Technical Analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.